Start with what a bond even is. A bond is an IOU. You lend money to a government or a company. In return, they promise a fixed coupon, a set interest payment, and your principal back at the end. The coupon never changes. That fixed payment is the whole point, and it's also the catch. Because the world around that fixed payment keeps moving, even when the bond itself stays the same. Now the key move. Bond prices and interest rates go in opposite directions. Picture your bond paying a fixed 3%. Then new bonds start paying 5%. Yours is suddenly the worst deal. No one will pay full price for a 3% bond when 5% is on the shelf. So the price of your bond falls until its yield matches the new rate. Rates up, price down. The coupon is fixed, so the price has to absorb the entire shock. Now the real driver. The popular story is that all safe bonds move about the same, but the real driver is duration. Duration is the multiplier that says how much a bond's price moves when rates move. Frederick Macaulay formalized the idea back in 1938. The rule of thumb is simple. A fund with a duration of about 17 years loses roughly 17% for each 1 percentage point rates rise. A fund with a duration of about 2 years loses only about 2%. Same shock, very different damage. What actually moves the price is duration. The longer the wait for your money, the harder the swing. This is why the word safe is so misleading. Safe usually means low credit risk. It means you will be paid back. The issuer won't default. A long-term Treasury bond is about as credit safe as it gets. But credit risk is not the only risk. There's also price risk, the risk that the bond's value drops before it matures. A Treasury fund can be credit safe and rate fragile at the same time. So safe answers one question and stays silent on the other. Now watch it happen for real. For 40 years, from about 1981 to 2021, rates mostly fell and bond prices mostly rose. A whole generation learned that bonds only drift upward. Then 2022 arrived. Rates rose sharply and fast. Long-term Treasury bond funds, the credit-safe ones, fell roughly 30% or more. It was the worst year for bonds in modern history. Default risk was near zero the entire time. The damage came almost entirely from duration meeting a rate shock. So why do long bonds swing so much harder? It isn't a flaw, it's just the math. A long-term bond locks in that fixed coupon for decades. When better rates appear, every one of those far-off payments looks worse, and the price has to fall further to make up for all of them. A short bond matures soon and resets quickly, so it barely flinches. There's no villain here, just a rule. The longer your money is locked in, the more a rate change is worth. Long duration is simply a longer lever. So, tie it together, and here's the answer to where we started. How can a safe bond fund fall 30%? It comes down to duration. A bond is a fixed coupon IOU, so when rates rise, its price must fall, and duration is the multiplier that says how far. Safe describes credit, not price. That's why a credit-safe Treasury fund could still drop sharply in 2022, just as Macaulay's 1938 idea predicts. None of this is a flaw. It's the mechanism. The next time something is called safe, you'll know to ask, safe from what? This is an explainer of the mechanism, not advice. Every figure here is illustrative, so always verify any plan yourself. Safe from default is not safe from rates. Duration is the price the long bond pays.